Okay, let's dive right into this. Welcome to The Explainer. If you've ever looked at the stock market and just wondered how on earth are certain companies valued at these absolutely astronomical numbers while others can barely attract a single dime, well, you are definitely in the right place today. We're going to figure out the exact metrics that capital markets use to measure true company value, and we're going to do it together.
To get us started, I want you to imagine a little scenario. Just picture this. You've got a cool £1 million to allocate. What do you actually do with that capital? Well, you basically have three options here. Option 1, you play it safe, lock it away in a bank vault. Option 2, you take a massive risk and start your very own company from scratch. Or Option 3, you invest in somebody else's established company. Ultimately, the entire global capital market exists to answer one single, incredibly high-stakes question. Which company actually deserves your hard-earned investment?
So here is our roadmap for today. First up, we've got the profit paradox. Second, unpacking the income statement. Third, EVA, which is the internal engine. Fourth, MVA, the market verdict. And finally, the ultimate valuation mystery.
All right, Part 1, the profit paradox. Why current profit is incomplete.
Imagine Company A. It generates £10 million in profit, it's growing super fast, and it's just pouring energy into innovation. Right next door, Company B also generates exactly £10 million in profit, but it's a mature, completely stagnant business, zero growth. Now, ask yourself, should they have the exact same value? I mean, intuitive logic might say yes, right? After all, 10 million is 10 million. But the global capital market loudly says no. Value depends on far, far more than just your current profit.
And here is exactly why that is. When you invest, you are absolutely not buying a company's past. Investors don't buy old products or brick-and-mortar buildings or aging machines. What investors do buy are future profits, future cash flows, and future growth. It's like a giant puzzle, and the critical question the market is always trying to solve is, how much future value can this business create? Current profit is basically just a rearview mirror, but investors, they're always looking out the windshield.
Moving on to Part 2, unpacking the income statement, deconstructing the accounting view.
Okay, before we jump into our practical case study, let's quickly lock in some foundational definitions. You're going to hear these three tiers of profitability constantly, so let's get them straight. First up is EBITDA. This is your raw operating cash generation, so revenue minus your normal daily costs. Next is EBIT. This is your operating profit after accounting for the depreciation and amortization of your assets, basically the normal wear and tear on your equipment. And finally, you've got net profit. This is the absolute bottom line available to the owners, after literally all costs, including interest and taxes, have been paid. So let's apply this to a real business. Meet our anchor case study, BrightBike Ltd. They're a bicycle manufacturer, and let's say they've just sold 200 bicycles at £1,000 each to a national distributor. That gives them a really impressive initial top-line revenue of £200,000. Sounds like a fantastic start, right? Let's move to the next level and see how this builds as we walk down the financial waterfall. Because, that £200,000 doesn't just sit in the bank. First off, we have to deduct £130,000 in normal operating costs. Stuff like materials, salaries, marketing. That drops our EBITDA down to $70,000. Then we have to account for £40,000 of depreciation on the production equipment. That leaves us with an EBITDA of £30,000. So yeah, that initial revenue is shrinking pretty fast.
Finally, we've got to pay the bank and the government. After deducting £8,000 in interest expenses and £4,400 in taxes, BrightBike is left with a final net profit of £17,600. So, let me ask you a rhetorical question here. The company earned a profit of over £17,000, but should the shareholders actually be satisfied with this business?
Part 3, EVA, the internal engine, measuring true economic health.
Okay, here is the massive twist. BrightBike made a net profit of $17,600. But wait a second. Shareholders invested £400,000 into this company, and they were expecting a minimum return of 10%. So BrightBike was actually required to generate at least £40,000 just to cover the cost of that equity. Subtract that $40,000 from their actual profit, and you get an economic value added, or EVA, of negative $22,400. They didn't earn enough. This quote-unquote profitable company actually destroyed shareholder value. No way, right?
So the absolutely crucial point here is this. Profit just isn't enough. A business must earn more than its capital costs to exist.
This is quite literally the inescapable rule of finance. If a business is just generating net profit, but that profit is less than what investors could have made elsewhere for the exact same risk, well, the company is economically dying, even if the accountants are saying it's profitable.
Think of the mechanical engine of a business like a giant seesaw. On one side, you have ROCE, the return on capital employed. On the other side, WACC, the weighted average cost of capital. True economic value is created only when the return you generate outweighs the cost of the capital you used to get it. If your cost of capital is heavier than your return, your EVA is negative, and your seesaw just crashes right to the ground.
Which brings us to part 4. MVA, the market verdict, the external expectation premium.
Now let's define market value added, or MVA. MVA is basically this massive expectation premium the market places on a company's future. It's simply the difference between the total market value of a firm and its book value, which is the capital originally invested by shareholders. If a company consistently has a positive EVA, proving it can efficiently generate returns way above its capital costs, the external market will reward it with a huge MVA premium. They're essentially betting that the company is going to continue to create incredible wealth in the future.
And this brilliantly illustrates the complete picture of corporate valuation. Think of it as a bridge connecting 3 pillars. On the far left, we have net profit. That's the accountant's view, looking backwards at operational yield. In the middle, we have EVA. That's the actual business reality, looking inward at capital efficiency. And on the right, we have MVA. That's the market's reward, looking forward at external expectations. So to summarize all of this, accountants track net profit, businesses run internally on EVA, and capital markets externally reward them with MVA.
Part 5. The ultimate valuation mystery. Applying the toolkit to reality.
All right, here is the literal trillion-dollar mystery of the Magnificent Seven. Apple, Microsoft, Alphabet, Amazon, Meta, NVIDIA, and Tesla. Investors are willing to pay trillions of dollars for these specific companies. But why? Is it just their current profitability? Is it their innovation? Or is it some impenetrable competitive advantage driving massive future expectations? These giants represent the sheer apex of future expectations in the global capital market today. To really understand why that is, you're getting a research assignment. You are no longer just passive viewers today. As of right now, you are active investment analysts. Your objective is to investigate the explicit relationship between economic value added, that internal engine, and market value added, the external verdict. And you'll be specifically targeting these Magnificent Seven tech giants using the provided data file.
Now to do this, we're going to follow a highly structured, 4-step computing procedure analyzing statistics from 2020 all the way to 2025. Step 1. Visual interpretation, graphing the correlation between EVA and MVA. Step 2. Statistical analysis, estimating the exact correlation coefficients. Step 3. Dynamics visualization to see how these metrics actually shift over that 5-year period for each specific company. And Step 4. Strategic synthesis, basically pulling all your findings together.
And that leads me to leave you with this final, provocative question as you prepare to analyze the numbers. Based on your strategic synthesis of the Magnificent Seven, what does the data actually tell you about global market expectations for the future? When you look really closely at how their internal engines drive their market premiums, what story is the capital market actually telling us? Grab the data, run the numbers, and discover the true mechanics of corporate valuation for yourself. Thanks for joining me on this explainer, and happy analyzing.